Hey everyone, welcome back to Corporate Decoder, the place where we break down the nitty-gritty of corporate filings so you don't have to. And let me tell you, this latest filing for TruGolf Holdings is a doozy. We're talking about a company trying to swing for the fences with their indoor golf simulators, but it looks like they're facing some serious headwinds in their financials and also trying to navigate a bit of a Nasdaq maze. So before we hit the links on these numbers, if you love getting the inside scoop on companies from actual filings, hit that subscribe button. And if you want to chat more about these sorts of deep dives and get even more exclusive content, join our Discord community, link down below. All right, let's dive into this filing from TruGolf Holdings Inc. It's an amendment to their registration statement, basically a prospectus detailing shares they're offering. It's dated August 2025, telling us about a lot of recent and upcoming financial activities for TruGolf. TruGolf is mainly in the business of creating indoor golf simulators and software. They've been around for quite some time, evolving from video game development to the sophisticated golf tech we see today. They believe indoor golf is a booming market and they're positioning themselves to capitalize on people's growing interest in golf that doesn't require a trip to a physical course. Let's talk about the money. In the first half of 2025, their revenue went up by about 9% compared to the same period in 2024. That's a positive sign, showing their products are gaining more traction in the market. However, when you look at the cost of making those sales, that also jumped up quite a bit, 27% in the same 6-month period. This means their gross profit, the money left after directly paying for what they sell, actually dipped slightly. They made about 5.6 million in gross profit in the first half of 2,000 million in the same period of 25. It's like selling more stuff, but not making as much profit on each item after all the direct costs. And then there's the operating expenses. Selling general and administrative costs shot up by 40% in the first half of 2025 compared to 2024. They attribute a big chunk of this to more spending on marketing and professional fees, which are necessary for growth but can really eat into profits if not managed carefully. All these increases in costs, while revenue grew modestly, led to a much bigger loss. Their loss before taxes in the first 6 months of 2025 was almost $6 million, more than double the loss of about $2.9 million in the first 6 months of 2024. That's a pretty significant jump in losses. Looking at the full year results for 2024 compared to 2023, revenue also saw a modest increase of about 6%. That's a good sign for overall sales growth. But again, the cost of making those sales decreased by 7%, which is interesting and positive. This meant their total gross profit for the full year 2024 actually improved by over $1.8 million compared to 2023, which is great to see. However, their selling general and administrative expenses also saw a massive drop of 40% in 2024 compared to 2023. They mention this large decrease is due to issuing shares to consultants as payment for services instead of cash. While this saved cash in the short term, it dilutes the ownership of existing shareholders. And then there's the other income and expenses line. This is where things get wild. For the full year 2024, this category showed a massive increase in expenses of over $5 million compared to 2023. This huge jump is primarily due to interest expenses, amortizing discounts on convertible notes, and writing off those debt discounts when the notes were converted or paid off. It's clear they've been dealing with a lot of complex financial instruments. Putting it all together, their net loss for 2024 was close to $8.8 million, which is actually an improvement from the net loss of over $10 million in 2023. So while they're still losing money, the bleeding has slowed down a bit on an annual basis. Now, let's talk about cash. As of the end of June 2025, they had about $10.1 million in cash. This is a slight decrease from the end of 2024 when they had almost $10 million. While $10 million sounds like a lot, it's crucial to see how quickly they're spending it. For the first 6 months of 2025, their operations used up about $1.35 million in cash. This means their regular business activities are burning through cash, and they need external funding to keep the lights on. This is a common story for growing companies, but it highlights the need for consistent revenue growth or successful fundraising. Financing activities brought in over $202 million in the first 6 months of 2025, mainly from issuing convertible notes. This shows they're still relying on debt and equity to fund their operations, which is not sustainable long term without profitability. TruGolf has also been in a bit of a dance with Nasdaq regarding their listing requirements. They've had to get temporary exceptions to regain compliance with things like minimum bid price and shareholders' equity. They did regain compliance with some of these rules, but they're on a mandatory monitoring period for a year. This constant back and forth with listing requirements can be a big distraction and raises concerns about the company's financial stability. It's not just the financials and Nasdaq issues. This filing is packed with risk factors. They talk about depending heavily on the strength of their brands, which is standard for any consumer product company, but they also highlight the critical need to raise capital to achieve their business plan. Their growth strategy relies on acquisitions and integrating businesses, which is exciting but very risky, especially without steady profits. This is a big red flag. They admit that without adequate funding, they might not become profitable and could struggle to attract more money. They had about $9 million in cash in May 2025, but their growth plans and operations are very cash intensive. Any future equity financing could significantly lower the ownership percentage of current shareholders, meaning your investment would be worth less per share. They're also worried about the rising costs of materials, labor, and shipping. This directly impacts their profit margins. If they can't pass these costs on to customers, their profits get squeezed. And like any product company, they face the risk of product liability lawsuits, which could hit their finances hard if they can't defend themselves or have adequate insurance. They even have a whole section dedicated to the volatility of their stock price, warning investors that they could lose their entire investment. They mention the possibility of becoming a penny stock if they can't maintain Nasdaq compliance, which makes trading their shares much harder. Now, something really eyebrow-raising is their dual-class stock structure. This means some shares like their Class B stock have way more voting power than others, like Class A. This concentrates control with the founders, meaning regular investors have a lot less say in how the company is run, which can be a concern for corporate governance. They even acknowledge that this might make their stock less attractive to certain investors and potentially affect the stock less attractive to certain investors and potentially affect the stock price attractive to certain investors and potentially affect the stock price. The filing also talks about selling security holders who want to sell their shares, totaling up to 2.77 million shares of Class A common stock. This is a substantial number of shares. If these holders decide to sell a large chunk of their holdings, it could significantly push down the stock price. This is a common risk when a large number of shares become available for sale at once. Looking at the financials more broadly, TruGolf is in a growth phase, but it's a phase with a lot of spending and reliance on external funding. Their revenue is growing, which is good, but their costs are growing faster, leading to ongoing losses. The Nasdaq compliance issues and the concentration of voting power with founders are also significant points to consider. Bottom line, TruGolf is trying to innovate in a growing market with its golf simulators and software. They've got a solid history and a passionate team. However, the company is burning through cash to fund its growth and development. They're heavily reliant on future fundraising, and the significant costs associated with their operations and financial instruments mean profits are still a ways off. Investors need to be aware of the high risks involved, including potential stock price volatility and the impact of future share issuances. The dual-class stock structure also means that founders will maintain significant control, which could influence decisions that might not always align with the interests of minority shareholders. So what's the play here? TruGolf has potential in the booming indoor golf market, but the path to profitability looks challenging and fraught with financial and regulatory risks. As always, do your own research before investing. Alright, that's our download on TruGolf's latest filing. What do you think about their financial situation and their strategy? Let me know in the comments below. If this breakdown was helpful, give it a thumbs up, subscribe for more corporate decoded content, and make sure to join our Discord community for more in-depth discussions. Thanks for watching, and I'll see you in the next one.